Okay, let's go ahead and post December. It's the last month in this series of this simulation. We're going to continue with our special treat and we're going to book it all in live mode, bookkeeping. And again, we're going to avoid using general journal entry interface so that we can again solidify our knowledge of debits and credits behind interfaces that accountants and bookkeepers typically use in QuickBooks. Okay, so let's get going. First, we have transfer to personal checking. We know that one, right? Transfer funds. All right, so it's coming out of our bank account and it's going to draw. We've done it before, we can do it again. Okay. Here we are again. What's going on behind this interface? Our bank account is being credited because it's an asset. And assets are reduced when credited. What else is happening? Our equity is being reduced, and equity reduced through debits. So here we are. Again, this amount right here is a debit for account 3700, and it is a credit for account 11100. These numbers here are balances for those accounts at the time of the transaction. So again, we don't have to ignore them, but they're not essential to the booking of this transaction. So here we are. Save and close. Okay, now we're going to book an invoice. Okay. Again, now that we're booking in live mode, we're actually going to enter the invoice date right here. Make sure it matches. Okay, we're going to continue using invoice number. Alright, amount due. Alright, terms are correct. What do we have here? We have food containers, right? Drink cups. So those are our restaurant supplies. Okay, good. So what's going on behind the interface, right? We know that our expenses go up. We know that much, and expenses go up when debited. And we have to have enough setting credit, right? And in this instance, as we remember correctly, it's account 20,000. That's our accounts payable. So what happened was we received the goods, therefore we kind of incurred the expense, at least on accrual basis. However, we haven't paid for it, and it is sitting in our accounts payable, right? So accounts payable go up, liabilities go up. We owe money for this purchase, and liabilities go up when credited, right? And expenses go up when debited. All right, and again, at this point, this expense account goes up on accrual basis, on cash basis. We technically have not incurred that expense until we paid it, but again, it's a separate subject. Let's go ahead and book it. Okay, we have another invoice we're going to enter. Alright. Again, 12/2/2020. Excellent. Alright. 25. Great. Alright, in this case, we have multiple expense accounts, right? We have our rent at 1,000. Our insurance. Okay, what else? We have our dues and subscriptions. We have our repairs and maintenance. And we have our advertising and promotions. Right, here we are. Let's go ahead and enter our reference number. Okay, just to make it bigger. All right, here are our expense accounts. So again, what's happening in terms of debits and credits, right? So we know that these expense accounts are going up, and they go up when they're debited. So here we are. Right, and now we need the setting entry, right? And it's just like the one before that, account 20,000, goes up. And that's our accounts payable. So here we are, debits and credits are in balance. So where are debits and credits on this interface, right? So again, this amount right here is going to be hitting our account 20,000, right? It will increase our accounts payable. So this is the credit for account 20,000. These amounts right here are debits for the corresponding expense accounts, right? Because debits increase expenses. So here we are, save and close. All right, we have another deal to enter. Okay, 20. Excellent. I'm going to continue using invoice as our reference number. Okay, those are cleaning supplies. Again, we've covered it, but again, it's important to solidify. Right, what's going on? We're borrowing, right? At this point, as we consume these items and we got this invoice, we owe money. So our liability goes up and liabilities go up when credited, right? What else is happening? Our expenses go up. Here we are, right? Good to go. Debits and credits are in balance. Again, this amount is a debit to this account, and this amount is a credit to account 20,000, accounts payable, right? All right, we have a deposit, right? We're putting some money in the bank. We have a cash deposit. So again, make deposits. Pretty straightforward, right? Account selected correctly. So we deposited this. We got this receipt from the bank, and we gave this receipt to our bookkeeper, or if we are doing it ourselves, we're booking it at the end of the day, right? All right, so here we are. Again, let's make sure we understand what's going on, right? Our bank account balance is going up. Our bank account is an asset. Assets are increased through debits. What else is happening? Our sales, our revenue go up, and revenue/sales increase through credits. Okay, so here we are. We're familiar with this interface, but let's solidify this amount right here, right? $448.25, right? It's a credit to account 41,100, and it's a debit to account 11,100. Okay. All right, we got another invoice here. All right, meat, bread, sounds like food purchases. Here we are. We're familiar with that. Let's solidify what's going on, right? Our expenses, when food purchases go up, expenses go up when debited. The offsetting entry must be credit. Here we are, right? We're familiar with that. Just again, want to make sure that we solidify our knowledge. All right. All right, very similar, but again, practice makes it perfect. You already know which accounts will be credited and debited. And now you can double check. So again, account 20,000, right? Our accounts payable is going up because we now owe more money to the vendor. In this instance, utilities to Go Inc., right? We owe them money. What else is happening? Well, our expenses, at least on accrual basis, is going up. Again, for tax purposes, there would be a difference. We'll discuss it in some of our future videos. Anyway, here we are, right? Ready to go. Save and close. One more. All right. Good. All right. By now you know, but you can just follow along. Right. Here we are. Accounts payable is going up. Accounts payable is a liability. Liabilities go up when credited. Expense, drink purchases go up. Right, here it is. Expenses go up when debited. Here we are. Right, good to go. Save and close. All right, we're going to pay an invoice, right, from soft drinks, the one we just booked, using our credit card. So let's pay our vendors, right? Pay bills. Before that, we were entering them. Now we're going to pay them. All right, soft drinks right here because it's due upon receipt, right? Okay, make sure we enter the date when we paid it, right? This is confirmation that we paid it. We paid it with a credit card, right? Here we are. Okay, amount is right here. So again, let's make sure we understand what's happening behind this interface, right? So we know that we're paying down account 20,000. Our accounts payable will be reduced, right, by that amount because we are paying Soft Drink to You LLC. What else is happening? Well, we're paying it with our credit card, right? So although account 20,000, that liability, accounts payable, will be reduced, another liability, because we're paying debt with debt in this instance, will increase, right? So the credit card balance will increase, so this liability will go down, this liability will go up. So technically, again, our net position on liabilities will not change, but what will change is to whom we owe money. Okay, so here we are, good to go, right? So pay selected bills. Okay, done. All right, now we're going to write some checks. And this time what we'll do is previously in November we printed checks. Now we're going to demonstrate how you can enter check numbers in the Pay Bills module if you happen to write it by hand, right? So in this instance, we're going to pay utilities to go, and we, I don't know, the printer didn't work, let's suppose, and we had to write the check by hand. So here we are. We're going to indicate that we're going to reflect it in our books. Okay, so here it is, utilities to go. All right, we're paying it on 12/9, in this case, check. So you can see previously in November we assigned check numbers. We printed check numbers. We were right here. Here we're going to assign it because we already wrote the check by hand. And now, I don't know, our printer didn't work, and now we're going to just indicate the check number. Okay, so here we are. Date is correct. So again, what's going on here? Let's make sure we understand, right? So our accounts payable balance will be reduced because we're paying down our liability, right? And our balance for our checking account, for our bank account, will be reduced as well, because once the check clears, right, the vendor, in this instance, utilities to go, once they cash that check, that will reduce the balance on our account, and bank account is an asset, and assets are reduced through credit. So here we are, right, assigned check, because we wrote it by hand, so let's make sure that's fine. Okay, let's move forward. Date is correct. Okay, so here we are. It asks us to assign the check. Okay, so we're going to enter it. Okay, so here it is. Check number, payment bills. No, fine. Okay, and that's the entry we just booked. Okay, next we have gas station receipt on our credit card, right? So we filled up our food truck, brought this receipt home, we're gonna book it. Again, we're familiar with this interface, make sure it's selected the credit card, right? Purchase. All right. Okay, so what's going on behind the scene, right? We know one thing for sure, expenses are going up. Expenses go up when debited. What else is happening? Well, we're buying it with our credit card, right? So our debt with the credit card company is going up. And debt/liabilities go up when credited. So here we are, expenses go up when debited. And again, just to clarify, and I know you know by now, this amount right here is a debit for account 63,200, right? And this amount right here is a credit for account 21,100, right? Okay, good to go. Save and close. All right. Next, we have a cash deposit. That's our cash sales. Alrighty, it's a very familiar transaction. Let's solidify. Bank account as an asset, it goes up, thus it is debited. Sales go up. Sales/revenue go up when credited. Okay, debits and credits are in balance. Good to go. Okay, let's go ahead and pay an invoice from Food Traders with our credit card, right? We've done it before. Okay, so here we are, Food Traders, make sure the date is correct. Credit card, okay, alright, so again, what's going on here? Well, we're reducing one liability and we're increasing another liability, right? So let's make sure we understand what's going on. Okay, so again, this account 21,100, right? It's going to be credited by this amount. And thus, this liability, this account will increase. What else is going to happen? We also know that this account, 20,000, accounts payable, will be debited. It will be reduced by this amount. So basically, this liability will go down, this will up. So we're moving money from one liability to another. Okay, good to go. Okay, another bill to go packs. Very much similar. We're paying it with a credit card. So just again, follow along. By now you know which liability is reduced, which liability goes up. Okay, so here we are, right? Pretty much familiar with it. The date is correct. All good. Let's continue. All right, we got transfer. That's for our credit card payment. So we can do, let's say, through our credit card, right? I've done it before. Let's use it again. So refund. Remember when we switch between these two buttons, right? What's going to happen here? This amount, right, will turn into a debit, right? Because it will be reducing balance on our credit card liability. So let's get it done. Alright, and we're paying it from our bank account. So here we are. Oops. Good to go, right? And again, let's make sure we understand what's going on here. So again, like I said previously, this is being debited, right? Because it's going down. Our debt with the credit card will be reduced because we're paying it down. So this window right here is a debit for this account 21,100. What else is happening? Well, we're paying it out of our account, our bank account, and thus the money will leave that account and the balance will be reduced. And bank account is an asset, and thus it is reduced by being credited. It makes sense, right? We got to enter the credit. We got to have that offsetting entry. All right, here we are. We're in balance. Save and close. Merchant account deposit. We're getting some money. So by now you know one thing for sure, right? Our bank account balance will be increased. When money is coming in, when it's being deposited, it will go up, and thus it has to be debited. Something else has to be credited, right? We have to have debits and credits in balance. And in this case, it's sales revenue because they go up under credited. Here we are, it's in balance, right? This amount, although we enter it once, it is both a debit and a credit, right? And it is a credit to this account, and it is a debit to this account, okay? All right, credit card bill, let's see, that's our cell phone provider. Okay, in this case it's purchase. So suddenly this window, once this is clicked, right, it becomes a credit. Let's book it. Okay, so here we are. This is our credit. This is our debit. Our expenses go up, our liabilities go up. All right, ATM withdrawal. We took some money out for personal reasons, right? So this one could be as a transfer funds, okay. We know that bank balance will be reduced because we took $350 out using ATM, and our equity in the business will be reduced as well. So here we are, we're in balance. Okay, we're going to pay some bills again just by writing hand checks, and then we're going to reflect it immediately in our books, right? So pay bills, here it is, Clean Depot. Again, make sure the data is correct. Okay. Make sure a signed check number is clicked in this case because again we printed in November. In December, let's say again our printer doesn't work, so we're writing it by hand and then immediately we're reflecting it. We know that our bank account balance will be reduced once the check clears, and our expenses, our accounts payable will be reduced as well. Talking about expenses. Expenses are not affected in these transactions because they were booked previously, right, when we booked the invoice. However, these expenses do become cash basis expenses right after this check clears, right? Once we part with the cash, it becomes essentially an expense from a standpoint of cash basis accounting, and the cash basis accounting is what we use for preparation of taxes in this instance. Anyway, let's move forward. We're good to go, right? Okay, everything is good. Date is correct. I'm going to assign the number. Okay. Okay, we have another cash deposit. Okay, we're well familiar with it, but again, let's solidify. Bank account balance goes up, thus it has to be debited. Sales / revenue go up, have to be credited. And even though this amount is here once, it is both a debit and a credit, right? Good to go. Okay, we're gonna pay another bill, invoice using a check. And again, we wrote it by hand in December. Here we are. Okay, what's gonna go? Our bank account balance will be reduced once the check clears, right? And our accounts payable, 20,000, will be reduced as well as it is debited. Again, when we're paying a bill which we entered previously, please again remember, you are not impacting the expense accounts. You impacted them once you entered the bill. At this point, you're just reducing your accounts payable balance. Very important to remember. Okay, good to go. Date is correct. Let's assign the check number. Okay, everything is good. Okay, we have a credit card receipt. Okay, filled up our truck with fuel, and expenses go up, and since we use the credit card, liabilities go up. Right, so again, let's enter it. Debits and credits are in balance, right? This account is being credited, this account is being debited. Okay, taking some money out. We covered this one, but again, let's make sure we do it again. Solidify our knowledge. We know that our bank account balance will go down, therefore we can easily credit that. And there, since we're taking money out of the business, our equity, right, our ownership in the business will be reduced, and therefore it is debited. Okay, here we are. And we have a cash deposit. We know that our bank account will go up, thus it is debited. And our sales / revenue will go up as well, thus it is credited. Debits and credits are in balance. Save and close. Okay, and we have a deposit coming from our credit card sales. Okay, here we are. Again, we know that our bank account balance will go up, thus we can easily debit that one. And we know that our sales, because that's the source of that cash, it's our sales, they'll go up as well. So here we are, debits and credits are in balance, save and close. Alright, we're good, and we completed booking essentially everything for December in live mode.